You may have clients that have planned carefully for their retirement years and have taken the steps necessary to ensure their financial security. In fact, maybe they're even looking to pass along some of their funds to their children or grandchildren. But do these clients have plans in place to address exactly how their funds will be transferred to beneficiaries? Frequently, you'll find that most people understand the accumulation and distribution phases of planning for retirement. A third phase that's often overlooked is the transfer phase, where using life insurance for legacy building can help. Life insurance is designed to pass along a death benefit to beneficiaries on a tax-favored basis. In addition, this key design feature can also help your clients pass along their funds as a legacy. When planning to pass along funds as a legacy, there are important items to consider, like whether or not probate will be an issue. Will beneficiaries face potential tax liabilities? Are the funds they have now guaranteed to be there in the future? Let's take a look at the legacy building concept, starting with the typical client profile. Usually, these clients are aged 55 to 75, either retired or retiring soon, and already have their retirement funds in place. Second, you should review your client's financial objectives so you can gain a picture of where the funds are currently allocated for retirement. There are a few items to consider when reviewing fund sources. Take note of any extra funds set aside in non-qualified sources, such as a non-qualified deferred annuity, certificate of deposit, savings account, or another distribution vehicle. Also, if there are accounts designed as payable on death or transfer on death, those are funds meant strictly to pass along to beneficiaries, meaning those are legacy building funds. Another question to ask is whether or not the client is taking minimum required distributions from a qualified source, like a pension plan or individual retirement account or IRA. If so, the client may not need those funds for retirement and could use them to buy a life insurance policy. The policy's death benefit could be used to create a generally tax-free legacy for beneficiaries. Gains on an IRA or qualified annuity are taxed as ordinary income, so your clients should discuss their options with a qualified tax advisor before using these funds to purchase a life insurance policy. Now let's consider a hypothetical example. Meet Mary. Mary is 65 years old, has enough funds for a secure financial retirement, and would like to pass some of those funds along to her son Dan and his growing family. She has $75,000 set aside for this goal and wants to make sure those funds pass to her son efficiently and in a tax-friendly manner. While there are many options for Mary, life insurance may be an ideal strategy to help transfer wealth to her son. Let's take a closer look. There are several items Mary should consider, starting with death benefit protection. It's important to establish a need for death benefit protection and whether or not life insurance is a fit for Mary. Should Mary die prematurely, the death benefit would pass to her son, generally income tax-free. Another item to consider is potential tax liability. An annuity, for example, offers tax-deferred growth, meaning Mary's son may have to pay taxes on this annuity as ordinary income based on his tax bracket at the time of inheritance. This extra income could bump him up on the tax scale, potentially causing him to pay higher income tax. We don't know what income tax rates will be in the future. They could possibly be higher than they are today. Additionally, if Mary has a medical emergency and needs access to the money in an annuity now, the amount taken may be significantly reduced after taxes. Life insurance policies may have an accelerated benefit available, which allows funds to be accessed on a generally income tax-free basis while the insured is living. The policy death benefit and any cash values, like loans, are also generally income tax-free. Next, will Mary's son have to go through probate? Even if Mary has a will in place, estate transfer can take time and may require legal assistance, which can be costly. A life insurance death benefit usually transfers easily and automatically to beneficiaries. Lastly, how long will it take for an alternative financial vehicle like an annuity or certificate of deposit to grow to meet Mary's goal? If Mary's goal is to leave the funds for Dan, then it's important to compare the value of each financial vehicle at the time of Mary's death to determine which vehicle may best fulfill that goal. It's unknown when Mary will pass away, but we can estimate about 20 years. Let's look at a hypothetical example to demonstrate how this may work. As mentioned earlier, Mary has $75,000 set aside with the goal of passing these funds to her son Dan. Assume she puts the $75,000 into a non-qualified annuity that will grow for about 20 years, at which point Mary will be in her 80s. That money has the potential to grow to around $164,000, assuming an interest rate of about 4%. What happens 20 years down the road when Mary passes away and the annuity passes to her son? First, he would be taxed on the growth amount of about $89,000. Let's say he's in the 28% federal income tax bracket. The amount he would actually receive after tax is just shy of $140,000, which is the net amount of gain after tax plus the original $75,000 basis, meaning he would have paid over $25,000 in taxes. Additionally, this inheritance is included as ordinary income, which could bump Dan up on the tax scale. It's important to remember that an annuity is to support the client's future by growing the value and providing a secured, stable source of funds over time. Life insurance is designed to support the beneficiaries by providing a death benefit after the insured dies. Be sure to discuss factors like cost of insurance, underwriting, surrender charges, and other fees associated with these types of products with your clients. Your client should seek a qualified tax or legal advisor for tax-related items before making a decision. Let's look at a hypothetical example for a life insurance policy. By using North American's Custom Guarantee Universal Life Insurance, Mary puts in $75,000 that would purchase just over $300,000 in death benefit today, guaranteed, based on a preferred non-tobacco risk class. When the unexpected happens, Mary's son would receive the death benefit, helping his financial security. Plus, it also increases his inheritance from the initial $75,000 to just over $300,000. Another important item to note is that with the life insurance policy, assuming Mary does not use any of the policy funds, the death benefit remains the same throughout Mary's life and transfers generally income tax-free upon her death to Dan. With an alternative financial vehicle, once Mary passes away, the funds may be taxed, thus reducing the amount transferred to Dan. As we stated earlier, clients should discuss their options with a qualified tax advisor before using these funds to purchase a life insurance policy. Based on these two hypothetical examples, the annuity would provide just under $140,000 after taxes, while the life insurance would provide around $300,000. By reviewing Mary's portfolio and assessing her life insurance needs, we were able to provide her with guaranteed death benefit protection along with an efficient and a tax-friendly solution to pass funds to her son. Legacy building using life insurance may be a strong option for your clients. Along with death benefit protection, it offers an opportunity for your clients to increase the funds they pass along to beneficiaries, generally income tax-free. Search your client list today for people who may benefit from using life insurance to pass along a legacy.